Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Today we're going to walk through what we're seeing in the equity markets heading into the second quarter. First, while the inflation rate peaked last year at 9% and has been steadily coming down, it's about 6% now, we still think that it's too broad-based for the Federal Reserve to try and switch to being more accommodative for equity investors. Right now, we think that inflation could come down to about 4% by the middle of this year, but then might stay at around that range. And one sign that this remains a bigger issue is the median CPI. So just taking the average component in that CPI calculation, it's still at a 7% growth rate versus where we were a year ago. So it's going to be difficult to see any real change in Federal Reserve policy, even if they stop raising rates here soon. This is a problem for U.S. consumers because it's now been more than a year and a half that wage growth has not been able to keep up with the inflation rate. So while they've benefited from those stimulus checks they received in 2020 and 2021, we look at the bottom of this chart, you can see the cumulative excess savings from those checks that were sitting in consumers' bank accounts. They're being drawn down. And so we think by sometime this summer, maybe in the third quarter, that excess savings will be completely gone, and we'd expect that to be a further headwind for consumer spending that might slow the economy down even more. That's a problem for companies' profit margins. They peaked in profit margins a little over a year ago, and while the margins have been coming down, they've been able to keep margins pretty high because they've been able to take up prices, and consumers and other businesses have been able to pay those higher prices. But with cost inflation still being an issue, if the consumer starts to fight back against those price increases, we would expect profit margins to come down further. And if you look at the last three recessions in 2001, 2009, and 2020, you saw profit margins bottom at around 10%, which right now we're still sitting between 13 and 14%. We've got further to go before you'd really start to say that margins have bottomed and are ready to start accelerating higher again. This means that we might be back to having a normal profit cycle through an economic cycle. This chart shows the typical uptrend in earnings per share for the S&P 500 over the last 70 years. And what we had that was different from 2009 up even through 2021 was that you never saw things get too extended on the upside or the downside in that earnings per share growth rate. But we're there now. And if you look at previous examples where you were hitting the top part of this trend line, you typically had a year or two where you actually saw earnings decline. And it would not surprise us at all if that's what we have ahead of us. And in that situation, it'd be difficult for the stock market to move significantly higher. One chart that we saw recently that we liked that looked at valuation for the equity market looks at the trailing price to earnings ratio along with the current inflation rate. And this chart adds those two together. So right now, the trailing price to earnings ratio is 18 and the inflation rate is 6. That PE ratio is a little bit above average, and then obviously the inflation rate is well above the 2% we were used to seeing the last 15 years. So if you add those two together, we're at 24 on this chart. And the key thing is the great lows in the stock market, which offered terrific buying opportunities. In every single scenario going back decades, you didn't hit that point until this number was at 19 or below. So even if the inflation rate falls from 6 to 4, we would need that price to earnings ratio to fall from 18 down to 15 or lower than that, which means that we've still got significant downside left in the stock market before we think you got a great buying opportunity. Two sectors of interest we wanted to touch on. First, banks in the United States after those couple bankruptcies we've seen in the last few weeks. Pretty simply, this is not the time to try and jump into banks despite the fact that they've gone down significantly in price. And the reason for that is their profits still have to come down further from what even we've seen some analysts adjust to. Right now, banks are having to raise the rate on customer deposits that they pay, and that's going to cut down on the net interest margin they can generate, which is the big driver of their profits. The other thing that will happen is because you've seen some customers move their deposits to other banks or other ways to try and generate a return, these banks don't necessarily know what their deposit base is going to be. And if they don't know how much they have to work with to then use for loans to companies or households, it's going to make it difficult for them to really be aggressive in their lending. And if lending growth is going to slow down, that means the overall growth in the economy will slow down, which is going to be another headwind for economic growth. The other sector we wanted to touch on was energy. since we've seen a lot of volatility in the oil price and the price of natural gas. To put it simply, the demand for energy globally tends to move in line with the overall growth in the economy. And given our view that we expect economic growth to continue to slow down, we expect there to be little to no growth in energy demand. And that's why we're still staying very defensive with our energy positions. We really only own pipelines right now in our income strategies, and we're not moving into any other areas within energy until we see those share prices come down more, and it gives us a better entry point to take advantage of that long-term opportunity. But right now, we think it's the short-term headwinds to that cycle that are a bigger driver. Another narrative that we've heard lately is, after all of the outperformance we've seen in US stocks versus overseas, is now the time to jump into international stocks? We would say not yet. Right now, if you're heading into a recession, the US dollar and US stock market tend to be places where global investors prefer to go because it's considered to be a relatively safer space to be. But this chart actually was interesting to us. It asked professional investors if they are more interested in European stocks right now relative to US stocks. And you've seen this spike in interest recently. But if we look back, all of these red circles point out other times there was a spike in interest in the European stock index. And we looked, in the vast majority of these cases, over the ensuing next year, the US stock market actually outperformed European stocks. So we would say now is not the time to get excited about international, although it's something that we're monitoring for a potential turn in the future. Finally, what we're seeing in specific indexes like the S&P 500 or the NASDAQ composite is they're getting very concentrated by the very largest companies at the top. This index just looks at the two largest stocks in the S&P 500 and what percent of the S&P 500 they make up. And Microsoft and Apple now have gone from 6% of the index in 2017 to 13% today, which is the highest weight we've seen from the top two companies going back to the 1970s. Our takeaway from this is that we want to continue to own Microsoft and Apple. We've owned them for years and years for our long-time equity clients, and it's done very well for them. But for new accounts, we're only going to buy if we think those two companies are undervalued, which we don't consider that to be the case today. And even if they were undervalued, we're only going to put about 5% of the equity portfolio combined into those two companies compared to the 13% weight in the index. The reason for that is it's going to be very difficult for those two companies and the tech sector in general to outperform to the extent that they did over the last decade. For that to happen again, it would be like saying that in 2030, 7 years from now, Apple and Microsoft will now be 25% of the index. There's just no precedent for that happening. So we think it's going to be more prudent to spread out our investments in the equity portfolio across an array of sectors, looking for the best opportunities in consumer, healthcare, industrials, energy, materials, financials. It doesn't all have to be in tech just because it's done so well for the last decade. Finally, what are we doing in our clients' equity portfolios? We're cutting the size of the outsized winners that have really been great drivers of the portfolios for the last several years, getting them back down to a similar weight to the rest of the positions that we have. And we're taking the proceeds from those trims and putting them into the handful of stocks that we're finding that we believe are undervalued, that are in stable sectors and can generate very consistent cash flows during this difficult economic time. We're monitoring what's happening in those very cyclical sectors like energy, financials, materials, and industrials, but at this stage, it's not the right time to jump in just yet. You need to see further slowdown and further deterioration in their profit expectations before you'd really start to get interested. Finally, the majority of the equity portfolios still remain in safe short-term treasuries generating a 4 to 5% yield, which is a great situation for us because that's a decent return to expect, and it provides us the optionality to wait for a great opportunity, and when we get it, we'll be able to put it to work quickly. We hope that gives you a sense of how we're seeing the equity market today, and if you have any questions, please contact us. If you like this video and want to stay up to date on our views about the financial markets, please subscribe below to our Oxbow Advisors channel.